Good morning. This is Dylan Jovine from Behind the Markets. Happy Wednesday. Today is Wednesday, February 5th. Today I want to talk about the earnings yield. The reason I want to talk about the earnings yield is it is a very important barometer of where we stand in the stock market. And right now it's flashing a warning sign that we haven't seen in 24 years, basically, since right before the dot-com crash. And what the earnings yield is, the S&P is expected to earn $268 for the entire S&P 500. And it's right now the S&P 500 trading at 6,000. So that's about 4.4%. So basically earnings as a percentage of the S&P 500 is about 4.4%. Now, professional investors, what they do is they compare that 4.4% they're getting basically from buying the S&P 500 to what they would get in 10-year treasuries, which is the most important of all the barometers that stock investors look at. And what we're seeing is with treasuries, the yield on the 10-year is 4.588%. Now, basically, what this tells you is that investing in 10-year treasuries is better than investing in the stock market, has a higher earning than the stock market. Now, that has not happened since right before the dot-com crash, which is a big warning sign. It's a problem. And it's only happened a few times in modern history where basically the earnings yield was this low. Usually it's 5.5%, 6%. Usually it's a bigger gap between what you get paid to own the S&P and what you get on 10-year bonds. Now, it's very important to understand that all professional investors, all investors, they look at their investment options and they say to themselves, gosh, I could buy the S&P 500, I could buy the stock market and basically get a 4.4% earnings yield. That's what earnings are doing relative to the value of the S&P. Or I could take my money and buy 10-year U.S. Treasury bonds and get 4.588%. Basically, U.S. Treasury bonds look more attractive than the S&P 500, even with the fact that the S&P 500 tends to grow earnings at about 10% a year. No matter what, the risk premium people are getting paid to own stocks isn't there right now. It's just not there. So it makes bonds much more attractive to folks like me. We said to ourselves, why would you own the S&P 500? And forget folks like me. I hunt for individual stocks all the time, and I find discrepancies in the market. But think about big money managers that manage tens and 50s and hundreds of billions of dollars, even trillions of dollars these days. And what they do is they're just buying index funds, a lot of them. And when you see index funds that look like this, you say to yourself, gosh, S&P 500 ain't where the action is. Might as well buy 10-year treasuries. It's safer. It's a better bet to put my money in 10-year treasuries than it is to put my money in the stock market. And that really harkens back to the cross currents and what we're seeing here in the market. We're seeing basically a market that has not been this overvalued since right before the dot-com crash. So we know that we're in a very expensive market. But look, like I always say, we got to play the ball where it is, not where we want it to be. People could do stupid things for a very long period of time. That is just the way human nature is. People could be very smart, but humans in a crowd, when there's money on the line, cannot be very smart from time to time. And this is probably one of those times. So I just wanted to know, this is a new warning sign. This just happened where the equity risk premium to own stocks has disappeared for the very first time since right before the dot-com crash. So as I always say, play it safe out there, and I'll see you tomorrow.